The second half of the trading year kicking off with a new record high. The S&P 500 closing at a new all-time high, and it was green arrows across the board with the Dow and the Nasdaq also posting gains. Among the best performing sectors, energy, utilities, and healthcare. Energy, the notable standout as oil soars above $70 a barrel, and that leads us to tonight's first question.
My name is Craig, and I have a question about the energy market. Over the past year, we've seen oil prices nearly double. The Biden administration has different policies on domestic oil production and relations with Russia and Iran than the Trump administration. How do you think the energy market will perform over the next 6 to 12 months? Thank you very much.
Tim Seymour, why don't you answer Craig's question about oil? Where do you see it next 6 to 12 months?
Absolutely, and I love this format, Mel. So look, Craig, when you think about the energy sector, there's a couple things that I think are cliches for a reason. One, the best response to higher oil prices, if you're a consumer, is higher oil prices, and that leads to a supply response. The problem with that right now, though, is you're not going to get the supply response that quickly. And today we learned that OPEC and OPEC Plus, which includes Russia and the Saudis now working at least more amicably than they maybe ever have, decided to punt on actually cutting output. So we're still kind of like the Fed. OPEC is taking a very accommodative approach to tighter supply. I should say, raise output, not cut. So to actually put a little bit more oil on the market. And they're not going to do it. So I think the best thing, you mentioned the Biden energy policy, and I've also said multiple times, the best thing to happen to energy prices was the Biden energy policy, which is clearly focused on EV, is focused on delivering a environmentally safe platform and pushing back on carbon footprint, which is great for the world. It's also great for the underlying price of energy companies. And I think I also have said many times, I believe oil companies especially are being run differently than they were 5-10 years ago. That means that they're actually being run for equity investors, not growth at all costs in an environment where it was really all about production.
Yeah, we've seen in particular integrated oils, cutting back on their capex, selling assets to strengthen their balance sheet, Nadine. But if you were to pick in the oil sector, where would you go?
We still like Europe a lot. So Shell is one answer to that question, and the second one is BP. They're both doing a ton. They're obviously, you're talking about shedding assets. They're focusing on green initiatives. And I think Tim pointed out a lot of really important things. And to the point here in California, when you do a lot of environmental practices, what ends up happening, as we saw with utilities, is prices go up. And so just for that reason, I think you can answer Craig's question that you should see in the next year, prices continue to go up, especially with reopening happening around the world. So, the XLE, just to let you know, is bullish, and it's still mid-range, but you could pick it up at maybe 52, 53 and have a good trade. Yeah, OPEC is going to have a critical meeting, James, and at that meeting, they're sort of weighing the balance between the reopening of major economies, particularly the U.S. and the UK, and Europe and the UK, but also the impact of the Delta variant, particularly in parts of Asia, slowing, for instance, China as well as India. So where do you come out on oil?
I want to piggyback on XLE that Nadine just mentioned. I think this is a good holding to get exposure to the sector. It's the select sector for energy. And XLE, although it's doubled, to the caller's point, since the vaccine announcement, we still haven't gotten back to that $60 plus level pre-pandemic. And so from a simple investment thesis, buy low, sell high, I think there's still, as Nadine agreed with me, still room to go to the upside here based on the macro picture and the fluctuations that we're inevitably going to see with the different oil companies and oil holdings. I think this is where we get an indication of the overall broad sector where we can go higher.
All right. Next question, another viewer looking for some guidance in the back half of the year. This time, this question is focused on the tech sector.
My name is Logan Hawley, and I'm from Austin, Texas, where I work in the tech space. My question for you is, with the rise in quantitative easing across 2020 and 2021, where we saw 40% of the U.S. total monetary supply being printed, how can we expect that and the rise of inflation to impact technology stocks that are already trading at such a high multiple to earnings, especially over the rest of this year? Thank you so much.
That is a great question from Logan in Austin, Nadine, that a lot of tech investors are wondering themselves. We sort of got a taste of what happens when inflation expectations go high, when the 10-year yield printed 1.74, and we saw that sort of revolt in the tech sector. But now that we've had that and we've had that taste, well, how do you think we do in the back half?
You know, I think Logan, if you unpack his question, had two things: printing of money, and then also about the interest rates, right? And so when you're thinking about those things, unfortunately, I think it's a thread the needle answer, which is you probably should have a Goldilocks situation for the next few months. But then come the fall, you got to be a little bit more careful with your tech because GDP growth is decelerating. And then inflation, it's really difficult to know right now how investors are going to react because inflation will remain at a high level, but the growth is going to be decelerating. And sometimes that ends you up in a situation of deflation, which is really bad for tech. That's the only time it's bad for tech. So you can hold on for a little bit while longer. But Logan, check in with me come August, September, and then I'll let you know what I think going after that.
James, what do you tell Logan?
I say if you're watching the inflation number as a predictor of where rates may go and what may happen with tech, follow the Fed's decisions around the changes in the estimates. If we look at the core inflation estimates for year end, they have been upwardly revised by 50% in just a month's period from the last meeting notes. And this number is going to continue to fluctuate, and the Fed is going to continue to adjust its stance on monetary policy. And I think that the impact is going to come if we see inflation accelerate and we see employment approach full employment over 5% towards year end. I think the Fed is going to come back and comment about the need to adjust its rate rise schedule. Not that we would get a rate increase in 2021, but I think we'll get a warning of a rate increase in 2022. And that, by association with them, put pressure on stocks as the enthusiasm comes out of those risk assets and we see the yield go back up on the 10-year.
All right, I'm gonna re-ask the question for Logan, Tim, and that is there one tech name you think could fare well no matter what the environment into the back half of the year?
First of all, I mean, Logan has got to be the coolest name I've heard, and you know, I just want to get that out there. We've said Logan this, Logan that. I wish I'd renamed my son Logan. Anyway, all right. So the bulletproof tech name, I think, has to be a tech company. First of all, it's not a high multiple tech company. And therefore, high multiple tech, I think, is very vulnerable in a rising inflationary world, and we've seen that. I think actually as the Fed steps in and pushes back, at least on the sense that they're, in other words, regain some credibility like they did 2 weeks ago and say that we are watching inflation, and it actually pushes rates down. And then you are actually looking for the tech companies that are the most reasonable valuations. And I think that brings you right to Google and brings you right to Apple. And I know, again, relative to itself, Apple's not cheap. But Apple has actually underperformed. And what's really actually broken out of and held the bottom of the range as you started to hear both the Fed, reassert itself somewhat. Apple and mega cap tech have actually started to move, right, in the last 2 weeks. So I think they're kind of all-weather stocks, whether you have slower growth or whether you actually the second derivative response to the Fed stepping in is actually people think the Fed's going to overstep its bounds, and actually you see a flattening of the yield curve. So I like Google because I think its valuation stands on its own in good times and bad. I like Apple because I think it's actually underperformed a bit. And I think as we start to get into the holiday season, although a lot of sales have been pulled forward, in addition to the macro arguments I made, I think we haven't priced in any of that, and a lot of money still sloshing around with the consumer.
All right, next up, a question on the reopening. Will it bring some magic to the House of Mouse? Let's get to Riley in Georgia.
Thank you for taking my call. With the economy getting back on track and everybody traveling again, do you think Disney will be a good stock for short term and long term? Thank you.
James, thoughts on Disney?
I think Disney had a streaming announcement and an amazing streaming result, crazy numbers, great popularity, and they rushed in and they pushed the stock up to a level that it couldn't sustain. I think once the vaccine announcement came, the reopening play got priced in on top of those streaming numbers, and we've been flat and we've been going down for the last couple of months. I think this trend continues. So much enthusiasm in a Disney stock. It's a great company. It's a great name. Great long-term hold that I would come in and buy at around the 130 level because I think between the streaming and the vaccine announcement, all the upside got priced in short term.
Tim, is Disney too expensive right now?
I don't think so, and I take the hybrid multiple approach to their streaming business versus their core business, and again, it's a distribution versus kind of the traditional business. And I think you've got an argument also that the company that really underperformed, right? Who was taking it on the chin in March, April, May? It was Disney, and it was, we forgot all about this other part of their business. Then, of course, as we got into COVID and we said, okay, yeah, their parks business is dead, their studio business has been stalled, that actually people focused on streaming. I think although streaming also, the good and the bad of pulling forward some streaming subs is that, look, it jump-started the model that was really the way you wanted to be investing in Disney that much going forward. So I actually think COVID was very, very important to actually getting streaming to be the major part of this valuation and pushing that front forward for investors. Disney's been a dog in 2021. It's actually underperformed. And I think it's a great second half stock, especially as we start to look and actually weigh the impact of the overshoot, I think, back into their parks and experiences business.
Nadine?
Bob Iger on June 1st sold 550,000 shares, so half of his holdings. I would follow what Bob did because he obviously is a pretty smart guy. It's like, do what they do, not what they say. So I would take some off the table right now. I think it's a great long-term story, but right now the trade's not in your favor.
Shepard Smith here. Thanks for watching CNBC on YouTube.